Bitcoin is a commodity that is scarce, where the primary use case is money, or that is a long-term store of value. So the reason you want to hold Bitcoin is you want to own a product on an open network for a long period of time. Its use case is to be money. When you're holding a stock, you're holding a share of equity in a company. In essence, you're owning a corporation as property. The first risk of any investor in an equity is governance risk. You're risking your money based upon proper corporate governance exercised by the board of directors and by the management team.
Michael Saylor is an American entrepreneur and business executive with decades of experience managing a publicly traded company. In a recently published interview with the Bitcoin Layer, Saylor gives some important trade secrets every investor should consider before investing in equities. More importantly, Saylor, whose software company currently holds the largest Bitcoin holding of any publicly traded company, discusses why the leading crypto asset is superior to equities and equity indexes as a long-term store of value. The cryptocurrency industry was created to shield savvy investors from the faulty and badly propped-up world of traditional finance. Though global equities far outweigh the cryptocurrency market in market capitalization, it is not difficult to see that the much younger industry is in much better upgrade to the centuries-old stock market. Critics of cryptocurrencies and other digital assets point to the industry's high volatility, regulatory risks, and the fact that digital assets have no intrinsic value as crucial setbacks to investing in crypto. In the same vein, they argue that investing in stocks is backed by its long history of solid returns, stronger regulation, and most importantly, the fact that such an investment depends on the success of the underlying company. According to crypto critics, stocks have an intrinsic value, whereas cryptocurrencies like Bitcoin and Ether do not. In his interviews, Saylor explains why these points that have long been thought of as strengths for the equities market are, in fact, great weaknesses. According to the MicroStrategy executive chairman, investing in stocks completely depends on the company's chances of survival and success. But there are so many reasons companies can go belly up almost overnight, and every one of those reasons is a point in favor of Bitcoin. If you are still divided about investing in stocks or Bitcoin, then you need to watch this video to the very end, as Saylor again woes us with his in-depth knowledge and expertise of the dark, murky waters of traditional finance. As we bring you this highly explosive debate of Bitcoin or equities, please ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithms so our videos can reach more viewers. Thanks and enjoy the video.
I think there's two questions there. Like, how does Bitcoin compare to stocks? And then why do people own equity? Why don't I start with the first question? What's the difference between Bitcoin and owning a stock? I think that, first of all, Bitcoin is a commodity that is scarce, where the primary use case is money, or that is a long-term store of value. Its use case is to be money. The value and use is store of value. But I think it's instructive for an investor that's thinking about whether they want to allocate to Bitcoin or whether they want to allocate to equity to consider the difference. So I think the place you got to start is, if you are a company, you're an economic creature, and everything in the economy, everything in the world wants to kill you. And you need to have that understanding. Whereas Bitcoin is like a monetary virus or an energy virus. A corporation is a creature. And so if you want to understand the risks that corporations face, it's instructive just to start by reading the 10Ks of publicly traded companies. So I would say a very practical education would be to purchase, to get the 10Ks of 10 or 100 different companies and just start to read all the risk factors, because these are actually pretty well written. Corporations spend a huge amount of money on lawyers, and the lawyers are highly educated, extremely thoughtful, extremely articulate, and very risk averse. And they will write pages and pages and pages of risk factors. This is the answer to the investor's question. If I invest $1 in this company, what could go wrong? and they give you an answer. And they really give you a parade of horribles. I've spent many years of my life, since 1998. I've been a public company officer. So I've been studying public company prospectuses and general business risk probably since 2 years before we came public. So that goes back a way. Um, and if I were to catalog them into a variety of classifications, I would start here. I would say the first risk of any investor in an equity is governance risk. You're risking your money based upon proper corporate governance exercised by the board of directors and by the management team. So the officers and the directors. If the board is bad or goes bad, or if the directors go bad, they can embezzle funds from the company. They can drive the company off a cliff. They can create a civil war within the company. If they can't work out their issues with each other, or if they can't navigate all of the challenges that approach the company in the future, then the entire thing breaks down. So governance risk is a challenge, and governance risk illustrates the general underlying challenge of corporations in general, which is the people are the weak link. Corporations rely upon human beings, and human action is ultimately the source of most of the liabilities in companies. And what you find is the more human action that is required to run the operation, the more risk there is. And many of the greatest corporations and the most successful equities are the ones that manage to execute on a business strategy with the least amount of human behavior. If the business is so simple that it doesn't need people, and there are no decisions to be made, and it runs on autopilot, those are generally good businesses. And the more people involved and the more decisions need to be made, the more risky it is.
Bitcoin is the best example of an asset running completely on autopilot without any interference from anyone. It is backed by pure mathematics that has held steady for 14 years without the need for a chief executive or any other sort of decision maker. That is why even the strongest crypto critics grudgingly accept that Bitcoin is in a world of its own. Last year, Apple co-founder Steve Wozniak said Bitcoin is a force of nature over humans and the only asset backed by pure gold mathematics. While describing the leading crypto asset to reporters, Wozniak had this to say: Bitcoin is mathematics, mathematical purity. There can never be another Bitcoin created. Bitcoin doesn't even have a creator that we know of. Bitcoin isn't run by some company. It's just mathematically pure, and I believe nature over humans always. This apt description is similar to Saylor's stance on the top crypto asset. Despite being a former critic himself, MicroStrategy has invested over $4 billion in Bitcoin. Let's get back to Saylor's interview as he discusses 3 other risks associated with investing in equities.
The second risk factor is operational risk. Every business has to do something, whether it's serve food or manufacture ketchup or ship products from point A to point B or fly airplanes or run a factory. The fact that it does something is operational, and if you don't operate the restaurant or the steel refinery or the aircraft properly, then the shareholders suffer. And it takes normally great degrees of talent, sometimes courage, sometimes commitment, in order to operate that business. And in the event of strange volatilities in the environment, the operation gets harder. But operation is never easy. If you've ever been in a steel refinery or an oil drill rig, you would know. Or if you ever try to fly an airplane yourself, even under the best of circumstance, it's not easy to operate. So that's the second risk. The third risk is strategic risk. In my experience, most of the software companies that we competed against, they failed because the board and the CEO made a bad acquisition. So the company will decide, strategically, we need to enter a new business. We're threatened by something. And they will change the operation. And maybe the strategy is, I'm going to acquire another company, so I pay $10 billion for a company that's really only worth $1 billion. And I blow up $9 billion of shareholder capital in one deal. That's just a strategic faux pas. The operation can be fine, but in one decision, the board and the CEO destroy billions and tens of billions of dollars of shareholder capital. And oftentimes, when you make those dilutive acquisitions where you buy something which just blows up in your face, then it's hard to recover from that. 99% of mid-sized software companies fail, go out of business because of dilutive acquisitions. In my career, every single one of my competitors went out of business because it did a string of dilutive acquisitions, which were ill-advised, where they were a weak company and they bought other weak and dying companies in an effort to stave off their own corporate demise. And they just accelerated their own corporate demise while they undermined their product. Even strong companies make these mistakes. Like Microsoft bought portions of Nokia and took multi-billion-dollar write-offs. SAP took a $10 billion write-off. It's always happening in one shape or form or another. That's the third risk. The fourth risk is financial risk. A company has a lot of money moving around. They have to put it in banks. In my career at MicroStrategy, we had money in a Brazilian bank. The bank was embezzled by the CEO. We lost the money. We had money in an Argentine bank. The Argentine government froze all the assets, devalued them. We lost the money. If you actually trust your money to a counterparty and they steal it from you, you're in trouble. So there's credit risk, there's counterparty risk, there's banking risk. You always have it everywhere. And if you trust the wrong financial counterparty, they'll bankrupt you. And we just saw in the crypto industry, we saw lots of companies go out of business, in some cases because they trusted another counterparty or they had their assets in another bank.
Meanwhile, the leading crypto asset in a 6-month high on Thursday as prices neared $25,000 per coin. Following a low of $22,664 on Wednesday, Bitcoin jumped to an intraday high of $24,769 on Thursday, its highest price since August 20, 2022. Following the sudden breakout, there have been lots of speculation about whether Bitcoin was starting its next bull run or if institutional investors were dumping their Bitcoin to avoid a coming massive price decline. As of press time, the leading asset is exchanging hands at $23,872, a 3.49% decline in the past 24 hours. Let us know your thoughts on Michael Saylor's interview and the recent Bitcoin price movements in the comments section below. Also, ensure you subscribe to the channel, hit the like button, and check out our other crypto-related videos. Thanks for watching.